Hello, I'm Allie Swafford, President of Prosperity Partners Wealth Management. Today we want to talk about the economy a year later after COVID began. This time last year, the World Health Organization had declared that the spread of COVID-19 constituted a worldwide pandemic. Stringent measures in the U.S. were being taken to slow the spread of COVID and flatten the curve. Lockdowns and shelters-in-place orders dealt a body blow to the U.S. economic activity. Investors who attempt to price in economic activity over the next 6 months had no experience to handicap a shutdown and eventual reopening of the economy. It was as if we were driving through a dark and foggy night with no headlights to guide our path. Consequently, investor reaction was swift, and the first bear market since 2009 descended upon investors. Volatility was intense. In just one day, the Dow Jones Industrial Average lost nearly 3,000 points, or 12.9%. This was March 16th, 2020. That day accounted for over 25% of the Dow's nearly 11,000 point break from peak to trough loss. The major market indices bottomed on March 23rd. The bear market lasted barely over a month if we use the broader based S&P index as our yardstick. It was a swift decline, but it was the shortest bear market we've ever experienced. The ensuing rally has been nearly unprecedented. Since bottoming, the S&P index advanced an astounding 77.6% through March 31st of this year. Its 3,972.89 close at the end of the first quarter put it within a 1.65 points of the prior March 26 closing high, and that is one of the top series of new highs since the beginning of the year. Since the end of the quarter, the S&P 500 has gone on to top 4,000. But let's look back and take a broader view. If we review the 6 longest bull markets since World War II, the S&P's advance over the first year tops all of the other prior bull markets. In second place at 72.4% is the bull market that began in March of 2009. That run lasted until February 2020. But I want to caution you that past performance doesn't always guarantee future results. If we gauge the first year of the 1990s bull market, the S&P had advanced 32.8% during the same period. It's an excellent performance for a period that runs about 1 year, but it would place the start of the long-running 90s bull market in last place among the 6 longest periods since World War II. Well, where are we headed from here? You've probably heard me say before, nobody has a crystal ball. No one can accurately and consistently predict what may happen in stocks. Nevertheless, let's look at what's happened in the second year of a bull market that were borne out after bear markets. Since World War II, there have been 6 other bear markets, sell-offs of at least 30%. In each case, the market posted strong returns in the first year with an average gain of 40.6%. Gains ran into the second year with an average increase of 16.9%. However, the average pullback during those 6 periods was 10.2%. So now let's not discount the possibility of a bumpy ride this year. Treasury bond yields have jumped as the government has embarked on an expensive $1.9 trillion stimulus package, and talk of new spending from Washington is gaining momentum. Further bullish enthusiasm can sometimes spark unwanted speculation. Might the economy overheat and spark an unwanted rise in inflation? Might rising bond yields temper investor sentiment? Up until now, investors have focused on the rollout of vaccines, reopening of the economy, and the benefits that these are providing. Today, momentum favors bullish investors, but valuations seem stretched, at least over the shorter term. When markets are surging, there's a temptation to load up on risk. Yet, we'd counsel against being too aggressive. Just as in the investment and financial plan, the emotional component of investing when stocks are falling, it also erects a barrier against the impulse to load up on riskier investments when shares are quickly rising. Life changes, and when it does, adjustments may be appropriate. Ups and downs in stocks are rarely a reason to make emotion-based decisions in your portfolio. Well, let's talk about avoiding 7 retirement traps. You've heard me speak on these before, but it never hurts to review. You've saved and invested for decades, and you've either geared up or are still gearing up for retirement. Maybe you've already left your job. While the idea of leaving your career behind may be appealing, it's a monumental change that can also be unsettling for some folks. You'll be sailing in a new direction, and you're going to take on new challenges. Your daily routine will dramatically change, and you'll begin to rely on those lifetime of savings. Well, what should you do? A more conservative investment approach may be in order. There was little reason for concern when you were 30 years old and volatility struck. In fact, the idea of dollar cost averaging and buying shares at a lower price was pretty appealing. Besides, the market has a long-term upward bias, and it would be decades before you would tap into your 401k or IRA. But today, market volatility can be much more disruptive. A big decline in stocks at the onset of retirement could create significant problems down the road. We've had these conversations when we talk about bucketing your money, the bucket plan and the now, soon, and later. We don't want you to avoid equities by any means. And some people get too conservative. I sometimes call that going broke safely. That's not the right choice. Instead, we want to take the right level of risk. In most cases, some exposures to stocks is the best path. But growth-oriented strategies of your youth that help build your nest egg should probably be tempered in retirement. Social Security. As you know, I teach classes on this for the American Financial Education Alliance, and there are reasons to opt to take Social Security at 62, but we must remember that this will reduce lifetime earnings from Social Security. Today's Social Security ages for full retirement range between 66 and 67 years old. Individuals who collect Social Security beginning at 62 receive 25% less in monthly benefits than if they'd waited until full retirement. And of course, this assumes full retirement and your birthday was somewhere between 1943 and 1954. Delaying Social Security for those same people born between 43 and 54 allows you to receive the maximum benefit, and that's an additional 32% over what you'd pocket at full retirement age. Rules governing Social Security are complex. I'd encourage you to attend one of our classes or pick this up from us individually. And the information we provide is just a general overview. We want to make sure we set this up for your unique situation. Implementing the correct distribution strategy. If all your retirement assets were in a Roth IRA, well, taxes would be a much less issue in retirement than it is for most of us who have our money in either 401ks or IRAs. Watch out for required minimum distributions. They have changed now to age 72. And you may decide to leave your IRA alone until that RMD is required. But as you look at the potential tax implications of pulling out that pre-tax money, remember, Uncle Sam's your partner in that IRA or 401k. We may want to look at some strategies to lessen that tax scenario for you. Another point is spending too much or spending too little. When you retire, your lifestyle will change. You're going to have the opportunity to enjoy new experiences and enjoy them on your own terms. But let me caution you, don't overspend in those early years. Just as we talked about market volatility or decline in the early years of retirement, overspending can be a problem as well. At the same time, some retirees are too cautious about spending. They have ample reserves, but sometimes guard them too closely. We applaud those who want to leave a financial legacy to their children, but balance that with have some fun in retirement. Be aware of scams. Be very leery of individuals and companies that prey on retirees and their desire to grow their savings. We're always happy to provide you with an objective review of any investments you are presented with. Remember, if it looks too good to be true, it usually is. Next point, watch out for medical expenses and long-term care. Well, you have Medicare and you probably have a supplemental policy, but deductibles, healthcare expenses that are not covered by insurance are always a challenge. And remember, Medicare is not the answer for long-term care. It's important to budget for insurance and medical expenses as they likely will occur as we age. Last point, you may live longer than you expect. Don't let the success of your retirement plan be predicated upon saying goodbye to your loved ones shortly after leaving the workforce. And in many of my classes, I ask people to raise their hands. Does anybody have a relative that lived over 90? Lots of hands go up. And we still have some hands at 100. Our oldest client today is 104. So remember, it's likely that you'll live into your 80s or 90s and continue to plan as if you'll be tapping your savings long after you've retired. Lastly, stay active and volunteer. It's going to keep you physically and mentally sharp. Just as we have a plan for your finances, have a plan that keeps you active and enjoying retirement. I hope you found this review to be educational and informative. Let me once again emphasize that it's our job here at Prosperity Partners to answer your questions, to discuss any matters that are on your mind. So feel free to give us a call, check us out online, find out what's going on. We've got lots of activities, lots of classes. I am humbled and honored that you've given me the opportunity to serve you. Make it a great day.